Hello, everybody. Good morning. This is Monday, September 18th. So I got a question from one of my viewers about loan classifications, and it's actually a great question. So my disclaimer and copyright notice: the information and opinions in this presentation are those of the author only and not my employers. I'm the author, not my employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only. It does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2023 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. I'm going to get rid of the further disclaimer because this is not about the Alaska or South Carolina or California Board of Accountancy. So the question I got from one of my viewers was, what if my company does not lend money to others very often, and we don't have the loan receivable account in the system? So if this transaction happened and my CFO didn't want to create the new account loan receivable here, is that okay if I key in the 3,000 to the account receivable instead of after debit this amount to the cash account? So let's just kind of talk about this over here. The distinction is a great question. And the first thing is, like, when I'm teaching financial accounting for my very first exam, which my 1A students just took, I'm not as big as in terms of classifying something as a note account payable or a loan payable. And it's just because you're starting to go through and learn accounting. But there's actually some really important distinctions, and let's talk about them. So the first thing that a loan receivable, a note receivable, an account receivable, these are all assets, right? We've either loaned money to somebody, we've sold something and the customer has given us a note, or we've provided a service or sold goods, which is going to be an account receivable. So an accounts receivable is generally going to arise when we've performed a service for a customer, meaning we either delivered goods, we've provided services, but they're not going to pay us immediately. So we end up crediting revenue, and you're going to basically be debiting accounts receivable, which is an asset, right? So an accounts receivable really involves from a sales transaction. For a note receivable, where does a note receivable come from? Usually can be the two I've usually kind of seen is if you're going to have a sale of equipment. And the reason why you would put that on a note is because of asset securitization, right? So if you want to go through and reclaim that asset, if the customer doesn't pay, you're probably going to do something on a secured note, and you're going to have to register it, all the other kind of fun stuff that goes along with that. The other thing that can happen with a notes receivable, how these come along, is that if you have an account receivable that hasn't been paid in 120 days and the customer says, hey, I need more time, well, we're going to call this now a note receivable. It's no longer an account receivable because you need to be paying us interest. So that can also be where a note receivable comes into play. Now, for a loan receivable is when a company makes a loan to a third party or a related party, and this is not going to be the same as others. When you're dealing with publicly traded companies, right? So for example, if Meta Platforms has a loan receivable or on their books, this is going to be a huge flag. Why would it be a flag for Meta Platforms, or maybe a smaller flag? But Meta Platforms is in the business of social media. They are not in the business of making loans to people. Bank of America, they're in the business of making loans, right? City National Bank, all these other banks, that's what they do. And we would see loans receivable. But if we're a smaller company, that's where we're going to get in a little bit of tricky. And this is where, if you don't have loan receivable in the system, and if it's not really arising from a sale, then that's something you'd want to be talking to the CFO about. And again, it's really much more of something where I'm sure this is probably a situation, given the dollar amount, it's like, dude, we had to give $3,000 to an employee or the CEO. He already paid it back. There was an emergency loan. That's fine, but you want to basically go through and make sure it's documented properly. So when we look at the nature, and let's just kind of talk about loans receivable. So again, publicly traded companies, you're not going to really find them. But however, in privately held companies, you may find the loans receivable. And it's just because of the nature of it. Well, the owner of the business wants to basically, they're loaning money to the company, they're borrowing money from the company. It really comes down to documentation. And when that happens, myself as a CFO, I wouldn't want to give anybody, if we're talking about loans and this is not in the course of our business, I need to go to my board of directors, right? What is the shareholders elect the board of directors who elects the CEO and CFO, right? They're the two appointments that the board of directors makes. And so if there is in fact a loan receivable, right, going back to the CFO, I would probably want to basically say, hey, wait a second, do we have policies and procedures in place when it comes to loans? And there's a lot of reasons behind this, because if I'm giving money to, or if I'm loaning money to a related party, meaning one of my employees, well, I should be doing things like a background check, a credit check. Do I need to secure the loan? How is this whole thing going to go through and work? And again, it might be absolutely fine, but a loan, a duck is a duck. It's a loan. It's not an accounts receivable, right? And again, the key thing here is it's really about disclosure, right? You want to basically say, hey, this was a loan that was being made. This is the repayment plan. The employee signed this note. And what you'd have happen is like Meta Platforms may have an employee receivable. Why? Well, if they were going to hire yours truly as their CFO, which they never would. But if Meta, actually, I love their financial reporting mode. It's pretty sweet. If they hired me as their CFO, I'm going to sell, well, Mr. Zuckerberg, you live in Palo Alto, right? That's really expensive to go through and find housing. So can I borrow some money and have it secured by the house and see what they say? So you can have loans receivable. Again, it's one of those things that the important thing is about disclosure, right? And I would, as a CFO, if I'm in a loans, and if I'm loaning somebody something to an employee and there's an employment contract, and the employment contract says that, well, Bennett, as a new employee of Meta, will be given a $500,000, actually for Palo Alto, probably a $5 million loan, up to $5 million to purchase a home. That is a loan receivable. But that's something, because I'm the CFO, my contract has to be approved by the board of directors. That's really the key of it, is it being approved by the board? Or if there are employee loans, is there a policy in place from the board of directors that basically goes through and says, okay, this is how we go through and do employee loans, and this is how we securitize them? It can get very, very tricky, because if you get a payroll advance, or if you give a payroll advance to an employee, can you deduct that from future checks? That's something you have to make sure, especially here in California, that it's, you have that fully documented. The other thing you also have to worry about too is that if I receive a loan, so the interest rate, the fixed rate, I think is 7 or 8% today. If I get an interest rate loan that is at 2% and not 6 or 8%, that creates another problem, because now I'm getting below market interest, which all those who are out there in the tax land, oh, wow, this is going to be income to this employee because it's a below market rate. So again, loans receivable for companies can be really tricky. But again, it happens. It's okay, but it has to be disclosed. The other part over here is that, and this is really why companies shouldn't not do loans receivable, unless if it's the CEO of the company, right? So like, Donald, I think it's Donald Bren, who owns the Irvine company. He wants to borrow money. Yeah, sure, dude. You do whatever you want. You own everything. So go for it, right? But the key, what happens though, is that if there are these types of transactions between officers and directors in the company, you now start saying, well, are we going to lose our independence? Also, I have to disclose these as related party transactions on my financial statements, meaning that this is going to be a flag for the auditors, because if you have dealings between companies, it involves additional disclosure. One of my favorite ones about disclosure, or just kind of think about it like this, I'm just going to pause really quickly. Okay. So just to kind of go over here in terms of looking at my friends at Cengage. Okay. When you have related party transactions, right, this is a little bit different because there was a board member who was on Cengage who also happened to serve as a director of Cengage Learning. Now, that's okay. However, because Cengage does business with Chegg, you have to go through and disclose it. So if you look over here, one of the board members is a member of the board of directors of Cengage until December 23rd, 2019. During those years ended, we purchased, this is pre-pandemic, 17.2, 15.1, and 11.5 of goods and services from Cengage. And then we had billings or revenues from Cengage respectively. So this is why when you go through and you're kind of looking at, well, related parties, is this really a big deal? And the answer is it kind of is. It has, like, look, it's just something that has to be disclosed. And if again, so kind of going back to this over here. So if, right, the key thing is you're loaning money to others, right? Is there a policy in place? Has the board of directors approved a policy? Now, again, if the CEO, if the single shareholder is the CEO and he's hired the CFO, then the CFO should just say, okay, I have to create this account for you, loan receivable, and that's what we do. But if that's not the case, you want to have a policy in place, right? Because you have to understand about if the company is using its cash to make loans to people, and that is not their primary business, you can get into, I don't want to say get into trouble, but you just have to make sure that everything is going through and being properly disclosed. So I wouldn't say it's okay to key in, if you credited cash, I would be debiting loan receivable if that's in fact what it was. If the loan was then repaid, then you go through from there. If an auditor is looking at this should be flagged, even though the amount is very small. What the question will be, well, if it's 3,000 today, what if it's 100,000 tomorrow? And are there policies and procedures in place to make sure that if there is in fact a loan receivable, which is okay, you can have employee loan receivables, but it has to have the proper documentation. So I want to thank my student or my subscriber for asking this question. It was a great one. If there are other videos that you would like to see, please feel free to leave a comment, and I look forward to seeing you on future videos. Have a great day.